Okay, this recording is concerning the Elliott wave theory. I just want to go through the basics, look at three simple illustrations just to show what it's all about. Now, here we have an Elliott 5-wave move. Now, I didn't really do this, but 1, 2, 3, 4, 5. Okay, it's really that simple. It's not a complicated theory, although some people have made it complicated in its application. And this is clearly an issue. Market action is not so simple. You're not going to see the market move like that. Okay, if we move down the page a bit, we'll see how the market does move. And you'll see this is an hourly chart of FTSE. This is back in I think September 2006. Now we've got the same basic pattern. Here we have got the 1, 2, 3, 4, and 5. But it looks nothing like the very stylized illustration I've just given you. The key rules are that the third wave is normally the longest, but is never the shortest. So if you've got a third wave that looks like it's the shortest, the count may well be wrong. Sometimes it does happen that the third wave is the shortest. I hesitate to say that because it is a it is a key rule of Elliott, and I will always be suspect. I will always be suspect of any move which does have a third wave, or an apparent third wave that is the shortest, and I may not trade it for that reason. Now, but in this case, we've got a clear third wave, which may not be the longest. The fifth wave may be more bigger, but it's certainly not. It's certainly longer than the first wave. Wave 4 mustn't go below the low of wave 1. So there's the low of wave 1. Okay, and there's the high of wave 1, and here is the low of wave 4. So in this case, the two are clearly not. There's no overlap between the two. With Elliott, it's a fractal theory. It predates chaos theory by many years. So each wave, in fact, does subdivide. The impulsive waves here are wave 1, wave 3, and wave 5. Themselves subdivide. In this case, on this chart, an hourly chart, we can't see the subdivision so well, although we can a bit, in fact. I mean, just one has an indication of 1, 2, 3, 4, 5, sort of on wave 1. It's not very clear, but I mean, obviously wave 5, I've marked it, so we've got a clear 1, 2, 3, 4, 5. Those are the impulsive moves. The corrective action, which are waves 2 and 4, are not so well formed, but we tend to see ABC moves. So, I mean, wave 3 is a fairly clear ABC. 1, 2, 3. This is more like a sort of drift sideways, but again, anything that's not clearly impulsive is corrective. So, this particular move is pretty good. It's a good signal. I send out daily reports on the market, and this chart, in fact, came from one of those reports. At the time I issued the report, this is where the high was. I suggested, as per the arrow, that we're going to go down, and we did go down. These are good signals, but they're not all good signals. So please be aware of that. There will always be losses, but the profits should be much bigger than the losses. Now the next chart is the 1987 crash. Now I weaned my teeth on this really, and it's still the best Elliott signal I've ever seen. That there is no real doubt about it. We've got this very clear 5-wave decline. 1, 2, 3, 4, 5. It's on the daily chart. I unfortunately haven't got intraday data anymore, but that was a clearly impulsive move. Then we sort of drifted up. It's a clear ABC, but it was very dithery around here. It just went sideways for a while. Then it just collapsed. Now, I never expected it to collapse quite so abruptly. I remember having a conversation with a GAN analyst a day or so before this happened, and he was saying, we both agreed that the market's going to fall back, and I think I then said, well, we're going to see at least 400 points because the wave 1 was 400 points, the wave 3 is always the longest, so I was expecting a move in excess of that move. I can't recall now actually the precise whether it was 400 points, it may have been 300 points, but the principle is that the third wave will be a bigger move than the first wave. He said, oh, no, 100 points. We'll see 100 points down. Well, in the event, I mean, I obviously won that particular argument, but I didn't expect it all at once. In fact, I traded it abominably. I think I had £600 a point running the Thursday before the crash. The crash came in on the Monday. It was quite a big position. There were 60 put options, and at that stage the FTSE options were £10 a point. So all I had to do really was go into a coma on the Thursday, wake up a week later, and I'd have been £250,000 richer when £250,000 was a bit more than it is now. Instead of which, I expected a bit of a blip up, so I sold I sold 2/3 of my position for peanuts. You know, I made some money, but it was peanuts. Looking to reposition on the Friday. On the Friday, England was hit with hurricanes, and the market was closed. So I was unable to reposition. And so instead of making, well, a considerable amount of money overnight, virtually, I actually ended up selling puts into the crash. These are options. You don't want to sell puts into a crash, really. That's why my hair's fallen out. Well, one of the reasons, probably. So the next 6 months recovering from this, in trading terms, I was stuck in a position that I could have lost a fair bit of money on, in fact. But the market, in fact, went sideways for quite a long time afterwards. I think it went sideways between that high there and that low there. And I had calls here, and I had puts here. And so the market very kindly, actually, in the circumstances, just let me off the hook. It's interesting, actually, that you know, these lows here, I think it is the major support. 1515 is the major support level for the market at the moment. It may seem extremely low level, but major bear markets do these things. They do take us back. Well, a major bear market will normally retrace about 80% of the markets. You know, we saw a high around 7,000, so you know, a low around 1,400 or 1,500 would meet that criteria extremely well. I try not to be alarmist, but that is definitely on the cards at some point in the next few years. Okay, so we'll go on to the next chart. It was quite difficult having a signal like that so early on in my career. I mean, it has addicted me to Elliott. I can't seem to escape from it. I don't really want to, actually. It is the more I use it, the more I find it useful, really. This chart is just subdividing. So we've got the 1, 2, 3, 4, 5, but wave 1 is subdivided into 1, 2, 3, 4, 5. Wave 2 into an A, B, C, and then the third, fourth, and fifth wave, which would also subdivide, not necessarily very clearly. You know, these things aren't crystal clear very often. All right. Now this chart here, just following on slightly, is not so clear, but yeah, I think it's important to look at some things that aren't sort of so very clear. But we've got a 1, 2, 3, 4, 5. That's not bad. So we then get a trade here. There were 2 trades we did at Lunchtime Trader. So there's trade 1 and trade 2, both based on this 5-way decline and the fact that we had a 5-way up to there, then a decline. So we thought a retest. So I think we bought here, and so that went okay. And then we saw another ABC here, so we bought there, and that went okay. So that was good. Okay. Well, at this point, I think we'll stop this illustration, and we'll have some questions. I hope you enjoyed that.